I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. On the back of 3 successive 25 basis point cuts to the RBA's official overnight rate, the major banks have reduced their standard variable mortgage rates by a cumulative 55 to 59 basis points over the same period. The government has announced an ACCC review into pricing changes by the major banks. Hopefully this is a political point scoring announcement, because the alternative is the Federal Treasurer doesn't understand how bank funding costs work, which is a scary proposition. Like any business, banks price their products based on the cost of providing the product and then adding a profit margin. In the case of mortgages, the underlying cost of providing a loan is a function of the interest cost paid by the banks for its funding. For the major banks, around 50% to two-thirds of their loan book funding comes from deposits. While the interest rate currently being offered on term deposits can be reduced, the majority of deposit funds are lower interest rate bearing savings and transaction account balances. The problem is that as the Reserve Bank reduces the official rate, more and more of the bank's transactional deposit base is paying zero or negligible rates of interest. Consequently, the funding cost of these deposits cannot reduce if there are further cuts to the RBA's official rate. The lower the RBA rate goes, the larger the proportion of the bank's deposit funding base that hits a floor of zero interest rates. If deposit rates cannot be reduced, the cost of funding doesn't fall, reducing the amount by which lending rates can actually be reduced without shrinking margins. With 65% to 80% of their funding coming from deposits, the regional banks like Bendigo and Bank of Queensland are even more exposed than the majors. The low funding cost base derived from deposits has historically been a material competitive advantage for the banks. But as the RBA's rate nears zero, this advantage is disappearing fast. And this is not the only problem faced by the banks. The major banks hold bonds amounting to between 20 and 30% of their loan book as liquidity protection. The problem for the banks is that the return they generate on these 3 and 5 year bonds has collapsed over the last year, with yields falling by 2/3 over this period. While the hedge book will smooth the impact, the returns generated on the liquid assets portion of their interest-bearing assets will fall materially over the next 3 to 4 years, unless there is a dramatic turnaround in bond yields in the meantime. For these 2 reasons, the outlook for bank margins is negative in the medium term, with the pressure growing with each additional RBA cut. But for investors, there's a beneficiary. Non-banks face less pressure on their margins as rates fall, because they tend to be fully funded by wholesale debt, the cost of which is linked to the bank bill swap rate. As rates fall towards zero, their funding costs will fall in parallel. Additionally, they tend to hold far fewer liquid investments than the banks, so the collapse in bond rates will have minimal impact on their margins. The diminishing funding cost advantage provided to the banks by their deposit base means non-banks are becoming more competitive. This can be reinvested into growing share or margin. The non-banks are already gaining share due to the loss of brand equity by the majors as a result of the Royal Commission, as shown by AFG's September quarter mortgage application data, with 46% of new mortgage applications processed by it going to the non-major lenders. This has increased from 35% 2 years ago. AFG itself is a major beneficiary of these dynamics, and as a result of its rapidly growing internally funded securitised mortgage book. AFG also benefits from the dramatic recovery in mortgage flow following the removal of serviceability requirements by APRA in June, with mortgage applications up 11% year on year in the September quarter. Both the margin pressure on banks and the recovery in mortgage demand put AFG in a strong position to grow revenue and earnings in the medium term. That's it for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.